In this presentation, we're going to record a loan with the help of bank feeds. In other words, we're going to see the money coming into our system with the use and function and help of the bank feeds, and we're going to record that information into our financial statements. Let's account with Sage Business Cloud Accounting. Here we are in our Get Great Guitars company summary page within Sage. We're going to be opening up our financial statements over here, going down to the reports, opening up that balance sheet report. Once opened, we're going to go up top and we're going to be right-clicking on that tab over there and duplicate that tab. That'll bring up the balance sheet on the right. I don't think we need the P&L or profit and loss or the income statement this time, because we'll just be working with the balance sheet. So I'm going to go down here. The date looks good. Let's go back to the tab to the left and then go and open up our banking information, banking in the ribbon up top. We're looking at that bank feed information. We only got one last transaction left in the Sage bank feed limbo. We're going to bring that one on over so we have all of them included in the financial statements. That's going to be the $65,000 here. And once again, our goal here is to think about every deposit. We're thinking on a cash-basis system. Our cash-based system, our default thought is all deposits are going to be going into the revenue type of account unless there's an exception. And typically, we will be able to pick out those exceptions because there's rare exceptions to when we get money, more money went into our account that's not from a customer. One, it might have came from us, or it might have came from like a loan, and those two should be pretty easy to see. Note that with the use of the bank feeds, it's kind of memorizing the last transaction here. So the memorization thing isn't perfect then within Sage if you're talking about types of transactions that will change. In other words, we have the same contact, in this case a customer, or we could think about it as a customer money in contact, but we have different accounts that it's going to be going to, and therefore you got to kind of double check the memorization thing isn't perfect. We got to go down here and say, no, we don't want it to be going to the owner contribution this time. We want it to be going instead to a loan type of account. So we're going to set up a loan type of account. This money came from a loan. Now note that if you didn't put it to a loan, the default often would be that it would be going into a revenue account, which also we do not want to do because it would increase the checking account, which is correct. But the other side then would be on the income statement as if we got revenue from it, which would also increase the income account for taxes, and we'd have to be paying taxes on a loan that we got out, and we don't want to do that. We want to record it on the books as a liability account for a loan. So let's hit the old drop down here and see if we have an account for loan payable. I do not see one, so we're going to set one up. So we have to go to the general ledger to set one up. So note that Sage doesn't allow us to just kind of create it on the go, which is probably a good thing. It probably gives us a little bit more control or likelihood that we're not just going to create, a bunch of different accounts. So I'm going to right click on the tab up top so we can have another screen that we can go in and add the account by going into the chart of accounts. So I'm going to go into that screen, and then I'm going to go back into the accounting tab to bring us back to basically the summary page within Sage. And then we're going to go to the settings tab in the ribbon. So we want to be in the settings tab within the ribbon, because that's how we get to the chart of accounts, which is under the financial settings section. So within the financial settings section, we're going to go to the chart of accounts. We're going to be adding a liability type of account. So you'll recall the accounts are going to be in order by category: assets, liabilities, and then equity, income, and then expenses. You'll also note that down here, I like to show all the accounts that I can on a page. So I'm going to make it to 50 because that's as many as they let me see at one particular time. So if I go back up top, we're looking for the liabilities. That was on page 2 for some reason. Now I'm back on page 1. So now I'm looking for liabilities down here. So we got and then here we have the current portion of the long-term debt. So when we think about the loans, you got to think about how do we want to track the loans. There's two things you want to think about. How can we do this logistically as easily as possible? And then two, how can we record it properly for financial statement purposes, which also includes breaking out the short-term and long-term portion, which could be kind of a pain to do. We don't do that like with every transaction because it changes with each transaction in a typical type of loan. So oftentimes I would suggest setting up actually a different account for each loan that you have. If you have more than one loan, you could track it in one account, and that helps you to tie out to the amortization table. And then either yourself or with the help of the accounting or adjusting department at the end of the year or month, then adjusting it to the short-term and long-term portion. Now you could then pick which one you want to use. Do you want to put everything into the short-term or the long-term and then make that adjustment? Now when you make the payment out of the software within Sage, it may not allow you actually to pay out of the long-term portion, because the idea would be if the payment is coming out of it, it wouldn't be long-term. It would have to be in the current portion. So therefore here I'm going to put everything, I'm going to put the loan, I'm going to set the loan up as a current portion loan and then make the payments out of it. And then periodically at the end of the month or year, I will adjust that loan and break out the long-term portion and put that into the long-term portion so that we have that adjustment at the end of the period. I would also do it instead of grouping all the loans together, break them out so that I can tie each loan out to the amortization table. So if I wanted to pick this payment and say I wanted to have each loan be separate, I might not add another account. I might go into this one and say, hey, look, I would just like to make a separate loan payable account for each item here. And maybe I call this note, payable. And then change the name. And then maybe I put like the last 4 digits of the number of the loan. And that'll help me to kind of track it. That'll be easier to use internally. And then when I adjust the financial statements for external use, I might want to like group these accounts together. And then display and break out the short-term and long-term portion for that. But the internal use is easier for me to break out each loan account. So again, I can tie out the loan number to the actual loan document and then adjust and see that the financial statements or the amount of the amortization table is tying out correctly. Okay, so then I'm going to go ahead and save that. And then let's go back on over to the first tab. That's account 2500. Let's see if we can find 2500 here. So there it is. There's the note payable that we just changed. It was already there. We just adjusted it now. Now I'm going to pick that one. It didn't pick it for some reason. I'm going to try it again. I want that one. All right. So now we're going to post this. What's going to happen when we do so? It's going to be increasing the checking account, and the other side's not going to revenue, but rather increasing a liability account also on the balance sheet. So I'm going to make this not a check either, an electronic. So there we go. Let's create it and take a look at it. So we're going to create it, and that's the last one that's been removed and has been liberated from limbo. And we're going to go over to the balance sheet over here. We're going to be calculating the balance sheet and check it out on this side. It's going to be over here on the checking account, increasing the checking account. Our checking account's looking very healthy now as compared to when we started out here. So there we have our $65,000 in the checking account. Let's go on back and take a look at the other side of the transaction, which is going to be down in the liability section. Going on down to the liability, there it is. So note, again, we can track each loan individually here. So now I can see this, and once I make payments, I can tie this out. Now, there might be a long-term portion to it, which we would have to break out. I'd have to break out the short-term and long-term portion with an adjusting entry at the end of the month or year. And then I would reverse it back into one account so that in the accounting department, just tracking the loan balances and tying them out to the loans would be easy to do. So then if we go into that transaction, then of course we're only going to have one item there yet because all we did was take out the loan. We don't have any payments on it at this point. There it is. There's the $65,000. If we go on back, notice there is nothing on the income statement for this transaction. It's a purely balance sheet transaction. So that's going to be it for now. Let's get out of here.